The IMF just cut global growth to 8%. That number right there. That is the number Wall Street does not want you to think too hard about. Because 8% is not a recession. It is not a crash. It is something more dangerous than either of those things. It is the number that sounds manageable, the number that keeps retail investors calm, keeps them in paper assets, keeps them trusting the system, right up until the moment the system reprices everything beneath them. And buried inside that April 2026 World Economic Outlook report, in the section most anchors skipped entirely, the IMF used a phrase they have not used in a major public document since 2008. They called the current environment a shadow of war economy. Not a slowdown, not a correction, a shadow of war. That is the IMF, the institution that launders bad news through academic language until it becomes unrecognizable, and even they ran out of softer words. You're watching this because the mainstream won't show you what that phrase actually means for your savings. Let me show you the numbers. The IMF report dropped on April 22nd. On that same day, gold was sitting at $3,212 per ounce. Silver was at $32.60. And the COMEX registered silver vault, the pile of physical metal that is supposed to back the paper contracts trading on the exchange, held 147, 3 million ounces. That sounds like a lot. It is not. Because on that same day, the open interest in COMEX silver futures represented a paper claim on 892 million ounces. That is a 6 to 1 ratio. 6 paper ounces promised for every 1 physical ounce sitting in the vault. But that's not the part that should concern you. The part that should concern you is what happened to that ratio after the IMF report hit. Because within 48 hours of that April 22nd publication, COMEX registered silver inventories fell by another 4. 1 million ounces, not total eligible inventories, registered the metal that is actually available for delivery on active contracts. It dropped. During a week when the IMF was telling the world that geopolitical fragmentation, their phrase not mine, was now a permanent structural feature of the global economy. Paper says the silver market is calm. The vault says something different. So let us start at the beginning. Let us start with what the IMF actually said, what they buried in footnote language, and why the metals market either has not priced it in or is being prevented from doing so. The April 2026 World Economic Outlook is 214 pages long. The headline number, 2. 8% global growth dominated every financial news segment for about 6 hours. By evening, it was already being contextualized, softened, given asterisks. Goldman issued a note calling it manageable. JPMorgan said the downgrade reflected known risks. CNBC ran a segment called IMF Sounds Alarm, but should you worry? The answer they gave was probably not. Here is what was on page 47. The IMF's scenario analysis section, the part where they model what happens if the current trajectory continues, projects that a prolonged fragmentation shock combined with trade retaliation cycles reduces global silver industrial demand by roughly 6% in the short term, but simultaneously disrupts the mining supply chains in Mexico, Peru, and Chile that account for 44% of global primary silver output. They are saying demand dips slightly and supply gets hit harder in the same scenario. At the same time, that is a supply squeeze dressed up in scenario language. But here is what they filed at 3 a.m. that nobody is talking about. Appendix Table 1, A3 of the same report contains the IMF's updated reserve adequacy analysis for resource-dependent economies. In that table, 5 countries that are primary silver producers, Mexico, Peru, Chile, Bolivia, and Argentina, are flagged with a new designation, Elevated Reserve Vulnerability under Fragmentation Baseline. That designation did not appear in the October 2025 report. It appeared for the first time in April 2026. And it means the IMF's own modelers believe those countries face currency and capital account stress severe enough to disrupt their export capacity. Mexico alone accounts for 23% of global silver mining output. Chile adds another 9%. Peru, 11%. You are looking at 45% of the world's silver supply sitting inside economies the IMF just quietly flagged as vulnerable. Paper says supply is fine. The vault data says something different. If you understand what you just heard and you want to keep understanding it, make sure you're subscribed and hit the bell. Because the next number I'm going to show you is the one the banks hope you never connect to this report. Let me set the scene for you more precisely. Because this is not just about a downgrade number. The IMF report is a data event, and data events move markets, but they also reveal market structure. They show you where the pressure is hiding. The gold-silver ratio on April 22nd was 101. 1 ounce of gold purchased 101. 6 ounces of silver. Historically, and I want you to hold this number, the long-run average of the gold-silver ratio going back 100 years sits around 60. It has briefly touched 120 during crisis moments. It has collapsed toward 30 during silver breakouts. At 101.6, you are in extreme territory. The ratio is telling you one of two things. Either gold is enormously overpriced, or silver is enormously underpriced. Given that gold's price is being driven by central bank purchasing at a pace not seen since the 1960s, we covered that in a prior video, the more likely answer is that silver is being held down. And that is the anomaly we are going to trace. Here is the first data point. On April 14th, 8 days before the IMF report was released, CME Group filed an update to COMEX margin requirements for silver futures. Margins were raised 2% for speculative accounts. That was the third margin hike in 11 weeks. 3 margin hikes in 11 weeks, at a time when silver's 30-day realized volatility was actually declining. Margins are supposed to go up when volatility rises. That is the stated justification for the mechanism. Volatility was falling. Margins went up anyway. Once you understand the ratio, the price action makes sense. Margin hikes on silver futures do one specific thing in the short term. They force leveraged longs to liquidate. When you raise the cost of holding a futures position, the traders who are long, betting that silver goes up, have to post more capital or close their positions. Closing a long position means selling. Forced selling means downward price pressure. Downward price pressure on a day when the IMF just told the world that the silver supply chain is geopolitically fragile means that the paper price and the physical reality have officially separated. Now here is the second data point. Shanghai Gold Exchange, the SGE, which is where China prices physical precious metals, showed a silver premium of $4. 18 per ounce above the COMEX paper price on April 23rd, the day after the IMF report. That premium had been running between $2, $80 and $3, $40 for the 6 weeks prior. It jumped 23% in a single session after the report dropped. The premium held through the entire dump in COMEX paper silver that followed. Let me explain why that matters. When the Shanghai premium rises while COMEX paper falls, it means physical buyers in China are willing to pay more for real metal, even as the Western paper price goes down. These are not speculators. These are industrial users, solar manufacturers, electronics firms, EV battery producers, who need actual silver in hand to run their factories. They are not playing a futures game. They are paying whatever the physical market demands. And the physical market demanded more on the same day that Western paper traders were being margin hiked into forced liquidation. This is the divergence. This is the pattern. And the pattern is not new. This is where the history matters. In March 2020, COVID hit. COMEX silver paper price dropped to $11.64, a multi-year low. At that same moment, the premium for 1 ounce silver eagles at APMEX, the largest US retail bullion dealer, ran to $6 to $9 per ounce above spot. Physical silver buyers were paying $17 to $20 for metal that the paper market said was worth $11. The paper price was a fiction. The physical price was reality. In February 2021, the Reddit silver squeeze happened. Retail buyers tried to corner the physical market. COMEX paper prices barely moved. Registered inventories dropped 27 million ounces in 2 weeks. The paper market held the price down while physical metal was disappearing from shelves globally. Premiums on physical silver hit 30% to 40% above the paper price. In both cases, and I want you to notice this, the pattern was identical. Paper falls or holds flat. Physical premiums explode. Registered vault inventories decline. And then weeks or months later, the paper price finally catches up to where physical was all along. Wall Street is not confused. They know exactly what this means. But that's not the part that should concern you most. The part that should concern you is JPMorgan. JPMorgan Chase is the largest holder of physical silver on the planet. They also hold the largest concentrated short position in COMEX silver futures, which is a fact that has been documented in multiple CFTC enforcement actions. In 2020, JPMorgan paid $920 million to settle charges that its traders engaged in spoofing, placing, and immediately cancelling large orders in the gold and silver futures markets over an 8-year period. 8 years? Not a rogue trader moment. A systematic institutional practice running from 2008 to 2016. The settlement did not end their participation in the market. It did not result in a single criminal conviction of a senior executive. It resulted in a fine that represented approximately 3 weeks of JPMorgan's annual profits. Now look at what JPMorgan did in the weeks surrounding the IMF report. Between March 31st and April 21st, 2026, the 4 weeks leading into the IMF publication, JPMorgan's COMEX silver warehouse saw 3 million ounces moved from eligible status into registered status. Eligible metal is metal sitting in the vault, but not specifically earmarked for futures delivery. Registered metal is metal that has been formally designated as available to settle contracts. You move metal from eligible to registered when you are preparing to deliver it, or when you want it to appear that you are prepared to deliver, which suppresses the urgency of a delivery squeeze. On April 23rd, 1 day after the IMF report, 1 million of those ounces were moved back out of registered status. Why would you move metal into registered and then remove it from registered within 23 days? If you are managing the appearance of vault adequacy around a known data event, an IMF report that would logically drive physical demand, the answer becomes uncomfortable. You inflate registered inventory before the event to prevent a delivery alarm. You deflate it afterward once the paper price reaction has played out. This number doesn't exist in a fair market. If you are connecting what I'm connecting right now and you want to see where this leads, subscribe now, because the next section is where the IMF downgrade stops being a macro story and becomes a direct threat to your purchasing power. Here is the third data point. The Bank for International Settlements, the BIS, which is effectively the central bank of central banks, releases quarterly derivative statistics. The most recent release, covering Q4 2025, showed that over-the-counter gold and silver derivatives held by major reporting institutions totaled $1. Over $4 trillion in notional value. That is not the COMEX. That is the unregulated off-exchange derivative market. The OTC market has no warehouse. There is no registered vault. There is no delivery mechanism. It is pure financial claim on a price, and it is more than 3 times the size of the entire global annual silver mining output measured at current prices. The fourth data point connects to the IMF's fragmentation language directly. The IMF's fragmentation scenario specifically models what happens when trade blocks decouple, when the Western financial system and the Eastern physical commodity system stop using each other's pricing benchmarks. We are watching that happen in real time. Russia, China, India, and the Gulf states have been settling commodity trades in non-dollar currencies since 2022. The IMF now says this is the baseline scenario, not a tail risk. The baseline. In that baseline scenario, the Western paper price for silver, set in Chicago, denominated in dollars, managed through COMEX margin mechanics, becomes increasingly irrelevant to the physical price being negotiated in Shanghai, Mumbai, and Dubai. The West is still pricing this like 2019, and the gap between the Western paper price and the Eastern physical price is the gap you are watching widen every single week. Let me give you the full pattern assembled. CME margin hikes force Western paper longs to liquidate. Liquidation drives COMEX paper price down. Down paper price in the West creates a premium for physical silver in the East. Eastern industrial buyers absorb physical supply at premium prices. COMEX registered inventories decline as metal flows east. Meanwhile, Western financial media reports silver falls, using the paper price, and retail investors in the West sell their ETF exposure, not understanding that the ETF price and the physical price have separated. Once you see the architecture of it, you cannot unsee it. And the historical precedent for what comes next is not ambiguous. In 1979, the paper-physical silver spread reached a level that the market eventually could not sustain. The paper price had been held below the physical clearing price for years through exactly the kind of concentrated short selling that CFTC enforcement actions later documented. When the constraint broke, when the Hunt brothers and Arab sovereign buying overwhelmed the suppression mechanism, while soarer woodities eased, silver went from 6 TOS to 40 NIs, 45 in 14 months, a 724% move. The mechanism was then broken by emergency rule changes, COMEX Silver Rule 7 in January 1980, which banned new leveraged long positions. The paper market was structurally modified to kill the breakout. We now have new versions of those same tools. Percentage-based margin requirements, which tighten automatically as price rises, making longs progressively more expensive to hold, were introduced in the COMEX silver market in January 2025. They function as a self-tightening price cap. The faster silver rises, the more expensive it becomes to hold a paper long position. The more forced liquidation occurs, the harder the cap pushes back. The cage has been rebuilt. The question is whether the metal inside it stays there. Here is what the IMF downgrade actually means for you. Not for hedge funds, not for sovereign wealth managers. For you, the person who may hold physical silver or a silver ETF or is wondering whether to. The person the financial media addresses last, if at all. The IMF cut global growth to 2%, 8%, and used the phrase shadow of war because the global economy is now being divided, physically, financially, and geopolitically, into 2 competing systems. One system is Western, dollar-denominated, financialized, built on derivatives, paper claims, and trust in institutions that have spent the last 20 years systematically demonstrating they cannot be trusted. The other system is Eastern, physical, resource-based, built on the accumulation of real assets, gold, silver, copper, oil, rare earths, at whatever price the Western paper market offers them. The IMF is not warning you about a recession. They are describing a structural transfer of real wealth. And the West is not just underpricing silver because of market inefficiency. Underpricing silver, keeping the paper price below the physical clearing price, serves a specific institutional function. It suppresses the signal. When silver is cheap, it does not scream inflation. It does not scream currency debasement. It does not scream geopolitical fracture. It sits quietly at 32 Oz, and everyone keeps their money in treasury bills and S&P 500 index funds and feels fine. The premium held through the entire dump. That is the tell. Every time the paper price has been hit in the weeks surrounding the IMF report, the Shanghai physical premium has held or expanded. That means the buyers who actually need metal are not fooled. They are not selling. They are not panicking. They are lining up to take delivery at the depressed paper price that Western margin mechanics have manufactured. They are on the other side of your paper trade, and they have warehouses. But here's what they filed in the data that changes the timeline. The CME's own preliminary delivery notice data for May 2026 silver futures, the contracts that entered their delivery window the first week of May, showed 1,147 delivery notices issued in the first 3 days of the delivery period. That is 235 million ounces of silver being physically claimed in 3 days, against a registered vault inventory that, as of April 24th, stood at 143. 2 million ounces. On its face, that sounds manageable. 2 million ounces against 143 million. Fine, except that 83. 4 million of those 143 million registered ounces belong to JPMorgan's house account. They are not available to settle third-party contracts. They are JPMorgan's proprietary position. Strip out the house inventory, and the available registered metal for third-party delivery is approximately 59, 8 million ounces. And the open interest in May contracts going into first notice day represented potential claims on 312 million ounces. 312 million potential claims. 59, 8 million available ounces. That is a 2-to-1 shortfall. If even 19% of contract holders demanded delivery, the available vault would be empty. And then something strange happened to the vault numbers. Between April 18th and April 25th, the week of the IMF report, CME vault operator reports showed 7 million ounces reclassified from registered to eligible across 3 separate vault operators, Brinks, Malka Emmett, and HSBC. That metal did not leave the vault. It was simply reclassified as unavailable for delivery. In the same week, the delivery demand data was showing elevated first notice activity. Why would 3 separate vault operators at 3 separate facilities all reclassify metal out of deliverable status in the same week? Simultaneously, Wall Street is not confused. They know exactly what this means. The answer that fits the data is inventory management ahead of a squeeze. You remove the metal from registered status before the delivery pressure arrives, so that when the squeeze comes, the officially deliverable inventory appears smaller, which gives the exchange grounds to cash settle rather than physically deliver. Cash settlement means you pay contract holders the paper price in dollars. You do not give them metal, you give them the suppressed price, not the physical premium price. Contract holders who would have received silver at a real-world value of $36 or $38 per ounce instead receive $32, $60 in cash. That is the mechanism. That is how the paper price is enforced against physical reality. And this is where the IMF downgrade stops being a macro story and becomes personal. If you hold a silver ETF, SLV, PSLV, or any of the others, you hold a paper claim. You do not hold silver. You hold a share in a trust that holds silver, managed by institutions that operate within the same COMEX framework we have been describing for the last 15 minutes. If the paper physical spread widens, if the scenario the IMF is describing as a baseline plays out, your ETF will price off the paper market. The paper price, not the Shanghai premium, not the physical clearing price. The managed, margin-hiked, institutionally shorted paper price. The only exposure that tracks the real physical price is real physical metal. That is not a sales pitch. That is what the data shows. Now let me give you the question stack that the IMF report forces onto the table. Why did JPMorgan reclassify 3 million ounces into registered status in the 4 weeks before the IMF report, and then begin moving it back out within 24 hours of publication? The most charitable explanation is coincidence. The least charitable explanation is that the movement was timed to manage delivery optics around a known macro catalyst. Which one fits the documented history of that institution? How can a market function honestly when the 5 largest COMEX silver short holders, all of them systemically important financial institutions, simultaneously hold short positions and operate the vaults that would be required to settle those positions in physical metal? The conflict of interest is structural, not incidental. The CFTC has documented it. The settlement funds have been paid. The structure has not changed. And the existential question, the one the IMF report makes unavoidable, what happens to the paper physical spread when the Eastern Bloc formally rejects Western commodity pricing benchmarks? The IMF's own baseline scenario says this fragmentation is not a risk. It is the direction of travel. Belt and Road Infrastructure has been denominating commodity contracts in renminbi since 2021. Saudi Arabia sold oil to China in renminbi for the first time in 2023. India is settling silver imports outside the dollar corridor. The pricing system that made COMEX the global silver benchmark is the same dollar system that is being structurally bypassed. When the benchmark breaks, when Shanghai pricing becomes the reference price instead of Chicago, what does that mean for the paper silver position you currently have in your brokerage account, priced at the old benchmark? The West is still pricing this like 2019. This is not a prediction. This is not a forecast. This is the IMF's own stated baseline scenario, translated out of academic language and into the question you actually need to ask about your own portfolio. Here is where we are right now, as precisely as the data allows. The gold-silver ratio is 1:1. 6, historically extreme, and at a level that has only been sustained when one of the two metals is being actively suppressed. Shanghai physical premiums are 12. 8% above COMEX paper as of the date I'm recording this. COMEX registered silver inventories declined in 4 of the last 5 weeks. CME margin requirements have been raised 3 times in 11 weeks. The IMF just published a 214-page document saying that the global fragmentation driving all of this is now their baseline economic scenario, not their downside scenario. Their baseline. And the April 22nd report, it contains one more number that almost nobody picked up. On page 112, in the section on commodity market vulnerabilities, the IMF flagged that global above-ground silver inventories, the total stockpile of identifiable, documented silver in vaults, ETFs, and exchange warehouses worldwide, have declined from 8 billion ounces in 2015 to an estimated 6 billion ounces in 2025, a 43% decline in a decade. At current industrial consumption rates, which the IMF themselves project will rise as solar and EV deployment accelerates, that inventory represents approximately 4 months of global supply. 8.4 months. Paper says the market is supplied. The vault data says something different. If you have been watching this channel for any period of time, you know we do not do resolution here. We do not give you a buy signal or a sell signal or a price target. What we give you is the structure, the architecture of the market as it actually operates, so that you can make a decision that the mainstream financial media will not help you make, because they are funded by the institutions that benefit from you not making it. And right now, the structure is telling you something specific. The IMF's shadow of war designation, which appears in print for the first time in that April 22nd document, is not metaphor. It is a technical classification for an economy in which military conflict, supply chain severance, and resource nationalism are now the baseline inputs of economic modelling. Not tail risks, baseline inputs. The same report that introduced that phrase also quietly lowered its projection for silver mining output growth in fragmentation-affected regions to 4% annually, against a demand growth forecast of 8% annually. The gap between 4% supply growth, and 8% demand growth does not close gently. It closes suddenly. If you understand what that means and you want to be here when we show you the next number, make sure you're subscribed. Because we are going to be watching something specific in the next 30 to 45 days, and you will want to have the context we've built in this video when that data drops. The premium held through the entire dump every time in March 2020, in February 2021. In every episode where the paper price was hit while physical demand was real, the Shanghai premium and the retail physical premium held. The paper price eventually followed. Not immediately, not on the schedule that impatient traders need, but mathematically, inevitably, in the direction the physical market already priced. Once you understand the ratio, the price action makes sense. 6 paper ounces promised for every 1 real ounce in the vault. A 43% decline in global above-ground inventories over 10 years. 3 CME margin hikes in 11 weeks during a period of declining volatility. 8.3 million ounces moved into and then out of JPMorgan's registered inventory within 23 days of a major macro data event. The IMF's own baseline scenario projecting a structural supply-demand gap in a critical industrial metal inside a document they titled, in part, Shadow of War. This number doesn't exist in a fair market. And the number I haven't shown you yet, the number sitting in the May 15th CFTC Commitment of Traders report in the disaggregated futures and options section in the swap dealers category, is the number I'm going to show you in the next video. Because the swap dealer short position in COMEX silver, the position held by institutions that technically classify themselves as hedgers, not speculators, which exempts them from position limits, just hit a level that has only been recorded twice in the last 15 years. The first time it hit this level was Q3 2010. Silver was at 18. 14 months later, it was at 49. The second time was Q1 2020. Silver was at 14. 18 months later, it was at 29. We are recording this in late April 2026. The May 15th COT report drops in 3 weeks. The question that should be keeping you up is not whether this matters. The question is whether the mechanism holds, or whether the May delivery cycle in the same month that the IMF's shadow of war baseline starts showing up in corporate earnings calls and capital flow data is the moment the paper and the physical finally and permanently stop pretending to be the same price.